Tax refund season arrives and everyone celebrates. The notifications, the screenshots, the finally energy on social media. And I understand it. Getting money back feels good. It feels like a win, but I need to tell you something that most finance channels will not say out loud. A large tax refund is not a win. It is proof that your money system has been failing you quietly for 12 months, and the government has been using your money, interest-free, while you waited to get it back. Stay with me, because by the end of this video, you are going to see that refund completely differently, and you are going to understand exactly how to redirect that money into something that actually builds your life instead of just giving you a temporary dopamine hit in April. Let me tell you about Simone. Simone is 27. She works full-time. She earns about $52,000 a year, and every single February, she does the same thing. She opens her tax software, punches in the numbers from her T4 or her W-2 or whatever slip her employer sent, watches the refund number calculate, and when it lands, this year it was $1,840. She feels a rush of genuine excitement. She screenshots the confirmation. She tells her mom. She makes a mental list of what she is going to do with it. New laptop she has needed for months. Clear the credit card balance that has been nagging at her. Maybe a flight somewhere. Maybe finally start that investment account she has been talking about. She has felt financially stressed for most of the year. This refund feels like relief. Like a bonus? Like the universe paying her back for a hard 12 months. Here is what Simone does not know. That $1,840 was hers the entire time. It was never the government's money to give back. It was her money, taken from every paycheck in small increments, $153 a month, through withholding. Money she never saw. Money she never had the chance to use, save, or invest. Money she gave the government as an interest-free loan for 12 months. And now she is celebrating getting her own loan repaid. She is not alone. Tens of millions of people do this exact thing every single year. Feel the refund as a gift rather than a return. Spend it on things they could have addressed months ago. Miss 12 months of compounding. Miss 12 months of debt reduction. Miss 12 months of their own financial momentum. The refund is not a problem. The system that created the refund is the problem. And that system is fixable. To understand why this matters so much, you need to understand what is actually happening with your money when tax is withheld from your paycheck. In most countries, Canada, the US, the UK, Australia, and many others, employers are required to deduct estimated tax from your salary before you receive it. This is called withholding or PAYE, depending on where you are. The operative word there is estimated. Your employer makes an estimate of how much tax you owe for the year and deducts it proportionally from each paycheck. The estimate is based on your base salary and your basic personal tax credits. At the end of the year, your actual tax situation is calculated. Deductions, credits, contributions, everything. If more was withheld than you actually owed, you get a refund. The government returns the overpayment. If less was withheld than you owed, you have a tax bill. Most people structure their situation, intentionally or accidentally, to receive a refund, because a bill feels scary and a refund feels safe. But here is what that choice actually costs. Let me use a straightforward analogy. Imagine you have a friend who needs a loan. You give them $150 a month throughout the year. By December, you have given them $1,800 total. In April, they pay you back exactly $1,800. No interest. Not a cent more than you gave them. Would you celebrate that transaction? Would you feel like you won? Of course not. You would recognize it as simply getting back what was already yours, while the opportunity cost of that $1,800 spent the year doing nothing for you. That is exactly what a tax refund is. The government is your friend in this analogy. They took $150 a month. They invested it. It earned them something. In April, they handed you back your $1,800 and called it even, and you took a screenshot. Now, I want to be clear that this is not about blaming anyone. The withholding system exists for legitimate administrative reasons, and for many people, a small refund is a reasonable outcome, a minor overpayment that is returned without drama. The issue is when the refund is large, when hundreds or thousands of dollars have sat with the government for 12 months, earning you nothing, while you struggled with cash flow, carried credit card debt, or skipped investment contributions because money felt tight. The $1,840 Simone got back in April cost her the entire year during which she could have been using it. Let me show you the real cost of the refund system in Simone's life with specific numbers. Simone gets a $1,840 refund. That is $153 per month that was withheld above what she actually owed. What that $153 a month cost her, option by option. If she had carried credit card debt at 22% interest throughout the year, $153 a month applied to her credit card balance would have saved her approximately $270 to $340 in interest charges over the year, depending on her balance and how the payments compounded. She paid roughly $300 in credit card interest this year. She could have eliminated most of it with money that was sitting with the government instead. If she had invested that $153 a month at a modest 8% annual return, $153 a month invested for 12 months generates approximately $1,910 by year end, slightly more than the refund amount. Not dramatic in year one, but over 10 years, $153 a month at 8% grows to approximately $27,500. Over 20 years, approximately $89,000. Every year she continues the refund pattern instead of redirecting that $153. She is choosing the screenshot over the compounding. If she had used it as a monthly bill buffer, $153 a month in her account throughout the year means she is never scrambling, never putting an unexpected expense on credit, never the anxiety of the last week before payday. The refund does not fix cash flow. Having the money available throughout the year does. Now here is the comparison that lands hardest. Simone, refund pattern, over 10 years, gets $1,840 back each April, spends most of it, invests a small portion irregularly. Net investment from refund over 10 years, approximately $5,000 to $8,000, depending on her discipline in the moment of receiving it. Simone, redirected pattern, over 10 years, takes that $153 a month and automates it into her investment account from January, consistently. Never makes the impulsive April spending decision because the money was never a lump sum to be excited about. Net investment over 10 years at 8%, approximately $27,500. Same money, same amount. 20-year difference in outcome, entirely determined by whether it moved monthly or arrived as a lump sum in April. The lump sum is psychologically exciting and financially inefficient. The monthly drip is psychologically boring and financially powerful. Here is exactly what Simone does. Here is exactly what you do. Step 1. Calculate your actual average monthly refund. Take your total refund from last year. Divide it by 12. That is the number, the monthly amount that has been sitting with the government instead of working for you. Write it down. It is about to change. Step 2. Adjust your tax withholding. This is the step most people have never taken because they did not know it was possible. In Canada, submit a TD1 form to your employer. Review your personal amounts, eligible deductions, and credits you are entitled to claim. If you have significant RRSP contributions, childcare expenses, union dues, or other deductions, you may be able to formally request reduced withholding so your paychecks reflect your actual tax situation more accurately. In the U.S., submit a new W-4 form to your employer. The updated W-4 includes a more accurate withholding calculator. Adjust your allowances based on your actual deduction and credit situation. In the UK, HMRC adjusts your tax code. If you believe your code is causing significant overpayment, contact HMRC directly or through your employer's payroll department to request a review. In Australia, your employer withholds based on your tax file number declaration. If you have significant deductions, a tax agent can help you apply for a PAYG withholding variation to reduce the amount taken each month. In most countries, this adjustment is a form, a conversation with your HR or payroll department. It takes less time than filing the return that produces the refund you are currently celebrating. Important caveat: the goal is not to engineer a tax bill. The goal is to get close to neutral. A small refund of a few $100s is fine. It provides a small margin for error without giving the government a large interest-free loan. What you want to avoid is the large refund that represents significant monthly overpayment throughout the year. Step 3. Immediately automate the recovered monthly amount. The moment your adjusted withholding takes effect and your paycheck increases, that increase should never touch your spending account. Set up an automatic transfer on payday. The exact amount your paycheck increased, or as close to it as possible, moves directly to your investment account or toward your highest interest debt before you have any chance to absorb it into lifestyle. This is the critical step, because the temptation when take-home pay increases is to upgrade something, to breathe a little easier, to let the extra money disappear into the general flow of your monthly life. You have to be faster than your lifestyle. The automation has to be set up before the first adjusted paycheck arrives. Step 4. If you have already received a refund this year, deploy it with intention before the week is out, not eventually. This week, sit down with the refund amount and make one clear decision about where it goes. If you have high interest debt, it goes there first. A credit card at 22% is a guaranteed 22% return on every dollar you put toward it. Nothing in the market reliably beats that. If you have no high interest debt, open or top up your tax-advantaged investment account. TFSA in Canada, ISA in the UK, Roth IRA in the US, whatever your country's equivalent is. If your emergency fund is below 3 months of living expenses, split it. Half to the emergency fund, half to the investment account. The refund has already been spent 12 months waiting. Do not let it spend another week waiting for the right moment. The right moment is the week it arrives. Step 5. Change the emotional relationship with the refund going forward. Tell yourself this now so it is true when the moment comes. A large refund next April is not a bonus. It is evidence that the system is still not working yet. A small refund, or a near zero result, means the adjustments worked. It means your money was with you throughout the year. It means you had the chance to invest it monthly, reduce your debt, or simply have more breathing room in your cash flow during the 12 months that actually happened. That is the win, not the screenshot. Here is the reframe. The reason the tax refund feels like a win is the lump sum effect. Human psychology responds very differently to receiving $1,840 at once than to receiving $153 a month. The lump sum feels significant. It feels like a gift. It triggers a reward response that $153 on a random Tuesday in September simply does not. But the financial reality is identical. Same money, same year, different timing, and the difference in timing is worth thousands of dollars over a decade, purely because of how human psychology handles the lump sum versus the monthly drip. The people who build wealth quietly from ordinary incomes are not smarter than the people celebrating refunds every April. They just understand that lump sum excitement is the enemy of monthly compounding. They removed the lump sum from the equation. They automated the monthly flow. They made the wealth building invisible and automatic. Because anything that requires a decision in the moment of receiving a dopamine triggering amount of money is a system that will eventually fail. Simone does not need more income. She needs her $153 back every month instead of in April. And she needs a system that puts it to work before she gets to decide what to do with it. Next April, one of two things is going to happen. You're going to get a large refund and feel the familiar rush. Screenshot, plans, temporary relief, and then watch most of it disappear into the same things it always disappears into. Or you're going to get a small refund, or close to nothing, and feel something different. Not disappointment, recognition. The recognition that your money worked for you every single month of the year that just ended. That $153, or whatever your number is, compounded from January instead of sitting idle until April. That your investment account received 12 contributions instead of one impulsive lump sum in the spring. That your debt shrank steadily instead of getting a one-time payment that felt responsible in the moment but was 14 months late. The tax refund is not free money. It was never free money. It was your money, held without interest. For a year, you will never get back. Take it back. Adjust the withholding. Automate the monthly amount. Deploy this year's refund with intention this week. And next April, when your friends screenshot their refunds and celebrate, you will be the only one in the room who understands that the real win happened quietly every single month while nobody was watching. Drop a comment below and tell me, how much did you get back this year? And now that you know what that number actually represents, what is the one thing you are going to do with it differently? I read every comment. Tell me the number and tell me the plan. And I will tell you if it is the right move. If this changed the way you see the refund, share it. Because the person in your life who screenshots their refund every April and wonders why they are still financially stuck needs to see this exact video. Subscribe to Nuella Invests. Every week we have the honest financial conversation that turns what felt like a win into something that actually is one. See you in the next one.